me say Daniel is currently pursuing a PhD in business in Tel Aviv University, and he is visiting Cornell University right now where he's a guest lecturer and fellow at the Cornell FinTech Initiative. So, Daniel, can you hear us?
Yes, I can hear clearly. Thank you, Frank, for the introduction.
Perfect. Daniel, you have 15 minutes, please, and the floor is yours.
Perfect. Thank you very much. I'm Daniel. I'm with Tel Aviv University and I'm visiting Cornell. And this is a joint work with Will Kong from Cornell University, Wayne Landsman Admedo from UNC. And we're going to be talking about how investors in cryptocurrencies respond to increasing tax laws, increasing tax scrutiny. And we, just to giving get everybody on the same page, we are particularly interested in tax loss harvesting, which is essentially selling an asset at loss, buying that asset immediately back, so the investor keeps the same quantity of the asset, but can use the loss information for offsetting income. And because we want to know whether these investors are complying more with the tax authority, by observing tax loss harvesting is a proxy for compliance. So why crypto? Well, we are interested in this very interesting market, emerging market that right now is more than $1 trillion in total market capitalization, 21,000 assets. Recent survey shows 1/3 of the Americans aged between 18 to 29 has invested in crypto, and there's a growing need for regulatory oversight, especially concerning to tax compliance, because this isn't an easy to evade ecosystem, and there's a complicated framework relating to taxation. So what we're going to do in the paper, we're going to using a simple conceptual framework based on the theory of crime, and we're going to use two data sets to provide empirical support to our questions. First, looking to a pool of 500 large retail traders and their responses to tax scrutiny, and second, looking to billions of trades across several crypto exchanges, with the idea to provide complementary evidence and also to estimate the size of tax loss harvesting in dollars. Of course, I have only 15 minutes. I'm limited to the amount of information I can provide on this presentation. So here is just an idea on how the crypto taxation started in the United States. Bitcoin was born in 2009, only 2014 that the IRS, which is the tax authority, provided the first guidance treating trading Bitcoin as a trading properties. We solved part of this problem, however, created many other issues. For instance, some traders did not know exactly what is a taxable event, and many other issues relating to forms that you can acquire crypto. We could buy a crypto, we can get as a gift, you can get an airdrop and a hard fork, and so all this information was not provided in the first guidance. And in 2016, the Treasury Department sent a report to the IRS claiming that the IRS should provide more guidance, as and also raising the issue that investors are may be misreporting here, either intentionally or by lack of information. That guidance came only in 2018 March, solving addressing most of these questions, and then the IRS started increasing scrutiny in July with a campaign on the crypto space, and a year later, sending a letter to 10,000 investors at Coinbase, in which IRS got their information and telling them that you are probably misreporting. You have a period of time to do that reporting, otherwise you're going to face some actions by the authority. Nowadays, the IRS is using blockchain forensics to analyze data and make inferences whether traders are actually reporting their true income in the crypto space. So the first analysis, we're going to look into a pool of 500 large retail traders. We get this data from an accounting firm that did this income reporting. And essentially the basic question is how these traders respond to increasing tax scrutiny by the tax authority. Here, just to give some glance of the data, we are looking to the daily activities of these traders on averages. They trade about $47,000 a day. This is a little bit more than 16 trades a day. There's some diversity in the number of unique pairs and number of crypto exchanges. They have more winning than losing positions. Returns are just off the chart. The median 0.26% a day and 5.6% average daily return, with a particular trade being very happy and one day making almost 60% return. You can see that 1/4 of these traders are located in the United States. The remaining are overseas. 62% of the trades are originated in the initial coin offerings, which was a process very popular in 2017 that created several cryptocurrencies. And 40% of the trades falls in the period where IRS increases scrutiny. When you compare the US traders to international counterparts, you see that they're quite balanced on their trading characteristics. Still, we do some matching just to have some extra layer of robustness. So let's take a look at our first prediction, which is an increase in tax scrutiny leads to an increase in tax loss harvesting, which implies an increase in compliance. So let's pay attention on the red square. We are seeing here our first specification looking to how tax loss harvesting reacts to this interaction of RS versus domestic, which is a domestic trader against international counterpart during the period of increasing tax scrutiny. And it has several specifications, and including the fourth column, which is with the matched samples. All specification shows that domestic traders, they engage way more tax loss harvesting than their international counterparts when they are asking increased scrutiny. Here we're going to see for each of these specific events that I showed before in a very narrow window, and still are able to capture those effects, still, confirming that domestic traders are indeed engaging more tax loss harvesting than their international peers for the first event and for the second event, although in the second event you see a lower magnitude. The reason is that the first event came after 4 years of silence by the tax authority was quite impactful. So the second prediction that we're going to look into is that we expect that if these effects that we are observing are indeed tax motivated, they should be more accentuated during the period of fear that traders are more sensitive to tax, that they will rebalance their losses across the year, which is often the turn of the year. So you're going to test in a similar fashion, but specifically looking to end of the year and see whether domestic traders have a larger response. So you're going to add a third interaction here in December, which captures the last 2 weeks of the year, and then also see in January here the slightly different specification, because we can see the portfolio of these traders. So you're going to separate their winning from their losing positions, and tax loss harvest implies that they are losing, so they are selling a losing position and buying that immediately back. So you're going to concentrate on the losing side, and the coefficients here shows that domestic traders, they sell way more losing positions at the turn of the year than the international counterparts, consistent with the story that this is tax motivated. Then you're going to separate this between harvest sales and regular sales. And according to the wash sales rules, harvest sales is buying back the asset within 30 days. And we can see that indeed harvesting trading is a dominant strategy for domestic investors or US traders. So in general, we find evidence that suggests that US traders, they engage more tax loss harvesting than their international peers, especially in response to increasing tax scrutiny and during moments where investors are more sensitive to tax-motivated trading, such as the end of the year. So what we're going to do now, we're going to look into a second data set, which is more comprehensive, with two goals: one to provide complementary evidence to our findings, and the second one to estimate the size of tax loss harvesting in dollars. So here's a comprehensive data set of 34 large crypto exchanges. We're going to open their trading books and look into their trading data. There's about 3.2 billion trades in the period, $5.2 trillion. And we are interested in a particular variable, which is a wash sales, because selling an asset buying that immediately back is considered a wash sales. There is no wash sales rules for crypto, so traders can engage in it. And what you're going to do, we determine whether a wash sales, if a buy or sell order occurs in the same pair, same exchange at the same quantity and price, and within 60 seconds. Then you're going to scale that to the total trades daily, so you have a wash sales as percentage of total trades. And you're going to look here on this variable, how that behaves across all these exchanges, we can see that on average there is about 8.75% of the daily trade activity is wash sales. In a particular exchange, 100% in one day was the entire activity was a wash sales. So we know that wash sales may have some endogenous considerations. Because it's a very competitive market, there's more than 500 crypto exchanges. Some exchanges will use algorithms to generate and inflate volume in order to appear bigger and attract demand. There's a literature out there talking about that. And one of those papers I co-authored with Leandres and Amiron. And you want to distinguish your proxy from these endogenous considerations to an exogenous considerations that capture tax loss harvesting. So you're going to do an experiment. We're going to see here, we're seeing here the price of Bitcoin as a percentage of its highest peak, which was this November 2017. And throughout 2018, there was about 70% price decline. So we are interested, we expect that because there are losses in this market, in the end of the year is a potential harvest period. So we want to know what happens to our wash sales measure in that particular period. And you're looking to exchanges that are highly regulated in the United States, like Coinbase. You can see here a plot of the wash sales in percentages. During the year, it's almost flat, but during the harvest period, it peaks above 30%. That also happens in the Kraken, which is another crypto exchange related to the United States, Binance. And you can see that it's happening in many crypto exchanges, so it's not an endogenous, it's not driven by volume inflation, it's indeed driven by some market force, which we claim is tax loss harvesting. So we're going to look into a highly liquid pair, Bitcoin to Tether, in a highly regulated exchanges, and during the harvest period, well, all these three, they mitigate volume inflation, and so any peak on wash sales could be attributed to tax loss harvesting. So we're going to generalize our previous results, and for that, we're going to compare crypto exchanges located in the United States versus crypto exchanges located elsewhere. And we're going to find that indeed there is increasing wash sales, which for the crypto exchanges with presence in the United States. And if we restricted the sample to exchanges regulated in the United States, then the impact is even higher. And here, if you plot that wash sales, particularly for these individual crypto exchanges. In the second application, you're going to estimate the size of tax loss harvesting in dollars. Here is the simple math. We're taking an average of wash sales in a highly regulated exchange versus the wash sales that happens during the tax loss harvest period, and this volume is the wash sales total volume in dollars. We had this version of estimate tax loss harvesting for each crypto exchange, but then we were scared to get sued by them, so we're not bucking them, putting them in buckets of highly regulated exchanges, and so we have to volume weighted or weekly weighted or wash sales volumes on that particular period. The bottom line is that doing that math, we really have a portion that is the volume attributed to tax loss harvesting. We take into consideration the depreciation of the asset throughout the period. Remember, 2018, there was 70% price decline in Bitcoin. So you have to take that into consideration to see how much could be used for income reporting. And the average tax rate in the United States is 30%. So you have a range between $10 billion and $16 billion of tax loss harvesting that was possibly used to offset income in 2018, and you are looking only into Bitcoin, so this is likely underestimated. If you take that number into context, the federal capital tax gain the same year was about $160 million. This is about 5 to 10% of tax revenue losses to the tax authority. So I just have 1 minute left. Unfortunately, I won't have time to talk about policy considerations. However, I want to show one slide before I conclude, which is this one. In the United States, agencies, they treat cryptocurrencies differently. The tax authority treats it as a property. The CFTC treats it as a commodity. The SEC chairman Gary Gensler has provided many statements claiming that crypto is a security. FASB which is used for accounting for firms, how they disclose information on crypto treats the financial asset. It's only see that there's a disparity on how agencies treat crypto, and the agencies are working isolated and ignore. Our recommendation is that agencies should talk more about crypto to coordinate policies in order to prevent that traders will move from a certain area that's under scrutiny to more innovative areas where tax scrutiny is not reaching, and possibly even evading taxes. So thank you very much. I hope I finish on time. Thank you. I'm looking forward to discussing the comments.
Daniel, congratulations, very much on time, and thank you for a thought-provoking presentation. Now, to discuss your paper, I'm very happy to welcome Gabriel Mitrash. Daniel is a senior expert here at the EBA. He works at the Supervisory Review, Recovery, and Resolution Unit, focusing on resolution issues. Gabriel, thank you very much, and you have 10 minutes, please.
Thank you very much, and thanks for the opportunity to discuss this very interesting paper. So, Daniel and colleagues, you have my appreciation for tackling a very innovative issue, and also to spearhead somehow in not having in an area where we don't have the data, which I think is brave and challenging. I will try to make some critical comments with the hope to provide you some ideas, maybe to improve the paper and also the research. I understand you might be looking to continue this research. It's one of the stages. Just for background, at the start of your paper, you mentioned the fact that taxation is the most pressing for crypto regulation. I would say, maybe to put in context, you have also the issues of AML, CFT, and also financial stability. So taxation, it's not the only one, at least I wouldn't be able to put an order, but just to give some context, and I'll come back to my conclusion. So I think this is also equally important to mention. For the form and the structure of the paper, I think it would be good to have in mind a structure of defining at the beginning what is tax harvesting and then trade washing, because throughout the paper now, not every time, but most often when you mention these things, you also describe them, and sometimes it's not a very consistent description. So I suggest it will help also to read and to keep consistent. Just define once and then do it. Maybe if you, for example, you also mentioned Benford's law, but you mention it and then you actually talk about it later in the paper. So maybe if you have a read through, describe at the beginning, define, and then don't use only the terms. Also, you had very good examples for tax, harvest, and wash sales on crypto. So that was very good to exemplify what they mean. So I will stick to that, and give this definition. Also, some parts were very good. You had them also on the slide on the historic of taxation for crypto for the US. I think they are very good. However, when reading the paper, I felt they were diverting from the main purpose of your paper. So my suggestion would be maybe either to put it in an annex. The description is very good, so I'm not disputing that, and actually I think it should be there. So either have a different paper and then only reference it here. I think you have enough material there to have a separate paper on its own and simply say, as we said in the other paper, this is the historic of taxation, or in an annex. That will help streamline the overall structure. Related to this taxation and also to the terms you use, now in your presentation you talked about scrutiny of the tax authorities, but in the paper you also refer to awareness, which is different, and actually you didn't mention the investors' awareness. I mean, I think you cannot directly mention that. And to be a bit more pushy on this, I think actually it's not even scrutiny, it's actually a change in policy from the IRS, because you mentioned it. Actually, they emphasize, and when they bring clarity, actually they change their policy. They say, now this is in clear scope in the remit of taxation. So I would say maybe to make it clear also from the, from the beginning, say it's enforcement and change of policy change of policy and its enforcement, because this is at the core from my reading. Moving more to the to the core of the paper, I had a question on the model. For me, it was not very clear, so maybe worth explaining also in the paper why you used the factor domestic times IRS, because I understood in the model you have them also separately. So this would emphasize this usage of US and IRS in scope more than their simple. I did not understand why you felt the need to use the compound factor in the formula in addition to their single form. So maybe it's relevant, but it's worth explaining, I would suggest. Then with my background from the EBA, paying very much attention to the words, and coming back to the fundamental where you talk about tax harvesting and then wash trading. These, as I understand them, there are two separate things. Tax harvesting is permitted even by the IRS. Trade washing, not. And now, so using both tax harvesting with trade washing, of course, is not permitted or should not be allowed. That's the point of the paper, and you try to emphasize that it's the point. However, due to lack of data, as I understand it, but please correct me, that was my how I understood it, because you don't have data for tax harvesting, use the proxy of trade washing. So I think it makes it kind of difficult using this proxy to not conclude that tax harvesting happens jointly with trade washing. I don't have a solution. I know it's very tricky. This is why I think it somehow maybe to elaborate between the distinction of the two, that jointly they shouldn't be allowed to happen, and your proposal is fine to conclude how to tackle that. But separately, tax harvesting is fine if done within the regulatory framework for tax authority. Then on the results, I had a small question because you at some point you mentioned that the profits are not impacted for the variable domestic IRS. So for me, that reads actually maybe it's an indication they are not doing tax harvesting. I don't know. I understand it's a small part of the overall result in the numbers. So maybe it's worth explaining why you would consider that not to be an argument for not tax harvesting with greenwashing. Let me say I have very few points left. Also, at some point you explored the NFT and the move to potential to NFT and DeFi. I understand the concept. I might suggest to introduce it somehow earlier in the paper that you think that could be a consequence, because for me it came abrupt when you started to speak about measuring the volume of demand of NFTs and DeFi. Also, maybe, I don't know if doesn't make the paper too difficult to read, because again, it seems like a spin-off from the main thing. I think you could conclude shortly, it's an alternative. This is what investors could do. You can do additional research, because also, if I understand correctly, your research there is still in the early stages, so not very conclusive from your wording. So maybe, to leave the paper to its core. Also, for me, in this sense, it was not convincing the explanation that NFTs are used as long-term investments to avoid paying tax on short crypto positions. Maybe I could see it, but it was not convincing, and there was actually no explanation why you saw this was a hypothesis to follow. So maybe better explain the hypothesis in this sense. Then, okay, of course, in the conclusions, you indicate the tightening of the tax policies, and which I think is very natural. And then you move also to the bill, which I think fits fine. The other point could be here that, coming back to my original, because you say they could deviate investors to move to unregulated cryptos, basically to escape taxation rules. But if we come to my previous point on AML and know your customer rules, basically this should also shorten the gap. So they are to a certain extent interrelated. Also, you mentioned, I think in the conclusion, that it's not good for the society, something like that, the tax trading. I think it's permitted. I think it can be a whole discussion on this, but it's not, you don't discuss it in the paper. So it was not the point of the paper. Of course, it can be discussed. You can have a Pareto analysis, a Pareto efficiency analysis on this. Is it good? Is it bad? But I think it's a different paper. So here you're introducing a conclusion that was not part of the actual research. So I would stick it to the facts and to your research. Again, I think it was very interesting paper. It was very nice read, and it opened my horizons, because it's not one of my issues that I deal daily with, but it was indeed interesting. You point also to the lack of data, and you touch also rightly so in your conclusion that better reporting could be helpful also for research, but for regulation. So totally agree with that, maybe to suggest that you should actually emphasize that in your conclusions, because from the beginning you say you are lacking data and transparency, and that's one of the things that did not allow you to fully explore your hypothesis or to have to recourse to proxies. So I would suggest even more to say, well, on top of tax regulation that would adequately capture crypto, there should be also reporting designed for this, where you explain what are the shortcomings of not having the data, because you touch those points. So I think it's indeed a very interesting paper, and congratulations on taking the challenge to explore this novel area where data indeed it's not very clear, and as you mentioned, you don't know why the volumes or the trades happen, what's the reason. There can be concurring issues, and it's worth clarifying what are the drivers. I think that's very important also for financial stability issues. So are the volumes indeed real, attached to the economy, because that for me would be a conclusion, or not, which you indicate, or based on other research, not. So it could be a relief, let's say, for regulators from financial stability to learn that actually it's only to increase the market for certain asset, crypto asset, or to only to be able to avoid taxes, which you point in your paper. And then which is not illegal. In these conditions. So then, but I think that's the point. And to conclude also from a regulatory point of view, it's always trying to catch or to be inventive. There are rules. Players play by the rules, but sometimes there are loopholes. So you always need to be, as a regulator, aware where the loopholes are and address them. For me, it's very telling, if you remember in Formula One, I think in the 70s, where there was a brand, they came with 3 pairs of wheels, so 6 wheels, because there was a constraint for the grip to what was the surface of the tire hitting the road per tire. And they respected that, except they came with 6 wheels, not with 4. The next year, the regulation said you have to have 4 wheels as well. So I think it's this, and research proves, okay, there's a loophole. This is the magnitude. This is where it drives us. Maybe it's an easy fix. Let's do it. And it's a continuous circle. So thank you again for the opportunity to comment. Also happy to clarify and also to liaise bilaterally if you think some of my suggestions are worth further exploring. Thank you.
Thank you very much, Gabriel. That was very informative and thoughtful. So let's find out what does Daniel think about your comments. Briefly, Daniel. And let's prepare everyone to have the option to come up with your questions, comments, and also on the virtual chat. Okay. So Daniel, briefly, what do you think about comments by Gabriel? Are they too tough for you?
No, they're not tough at all. Actually, they're quite deep to the point. And Gabriel made an amazing discussion. We got several discussions in this paper, and by far you stand out. So just in general, so that you can get also opportunity for other people to participate. You're right. It's more than taxation. Issues in financial stability, investors' protection, national security, they are very important. And here in the United States, Biden passed an executive order earlier this year for all agencies to draft a plan of action, respect the limitations with data, as we know, all these fields. And I'm quite happy that I'm also researching on those topics too. In this paper, we focus on tax, but I've been working also on cybercrime, working on issues with investments like ICOs and ICOs scams and so on and so forth. But yeah, we are trying our best to attend all these aspects, given the limitation in data. But it's a quite vibrant field, quite interesting, and we were quite happy to promote the debates and get comments as you provided. I took note of all your comments. We'll definitely make a good use of them. And in general, this is I think it highlights overall the response for discussion, so you can have all other people participating too. But let's talk more offline later. Thank you, Gabriel.
Excellent, Daniel. I have a question here, physically in person by Jacob Gintelberg from EBA.
Thank you. Here's my physical question. So first a remark, right? It gives me great faith in humanity, right? It's good to see that the moment you open up for Wild West conditions in the market, that's what you get. Right. So that means that the old sins are, they're still there. That's nice. What I was going to say is I had a little bit the same comment, right? I mean, there's breaking the law and there's ethics and then there's, everything in between. But I mean, on the breaking the law point, right? I mean, tax stuff is one paper, I think. No, I would say your wash trades, though, for me are a good reminder. So if it were me, I would certainly try and have a look at the wash trades, which you had 8 to 10% of all trades are wash trades. So wash trades in these markets seem to come in two buckets, right? One is get the clients in trades, right? Make it look like this is an active exchange, even if it's not. I have no comment on that. Good luck. The other point of a wash trade is obviously market manipulation, right? Just to let people forget, you do this to create either upwards or downwards price momentum, so you can steal other people's money, right? It's just so. I think it would be nice to have a look at what is it, right? Because if you find very little evidence that there's an increase in either volatility or outright directional movements in the market as a result of your wash trades, I mean, I'm just saying if. That would mean it's mostly to lure people in. Fine. It may be less of a concern, honestly, But if you find that there are actually downward moves or upward moves or a notable increase in volatility, which is sort of micro stealing, that I think is a different issue, right? Then we're back to old shenanigans. And I would say, again, interesting to see how much. But certainly also back to the stability point I think Gabriel had, right? Which is that might worry us. If I have these sharp moves as a result of wash trading that is effectively market manipulation, that's a lot bigger of a policy issue for someone like me, at least, right? Whereas which particular exchange you trade your fictitious asset on, maybe I'm less concerned, honestly, right? But if there really is that type of old school shenanigans, I think that's a much bigger challenge, right? And it might explain why we see what I sense is high volatility of these markets on a constant basis, right? Which is, so I think that would really, you have all the data, you have all the techniques there. I mean, it's right there for the taking, would be my suggestion for you, yeah?
We can call out on that, Jacob.
Watch out, buddy.
Okay,
So yeah,
thank
you're
you,
right.
Jacob. Let
Well,
me
yeah,
see whether, Daniel, let me see whether there is any other question
sure.
in the chat. I don't see anything. So, well, I think that's a really, really good point, Jacob made. I mean, this is related very much with the fact that you were, and Gabriel was also mentioning about the fact that you also see a move towards, let's say, newer forms of crypto in terms of the movement of the changes in the trading behavior of crypto traders. So, and then you saw people going away from the US. So that's the key point. But yeah, last word to you, Daniel, please.
So yeah, so the 2 points. First to Jacob, then yours. For the Jacob, yeah, we know more about the first part that less interests you. That wash sales is used as a tool for market competition to attract demand, and then lure customers, and in the long term, the customers get a ripoff, right? We know less about impact to price formation on financial stability, so that's something that we definitely has room to work on. And connecting to the second point that has been made relating to innovative products, yes, you're right. There's more that can be done on that part. NFTs, non-fungible tokens, or decentralized finances, relatively new. The market boomed 2021 and then crashed this year. But the data is still forming, but we will definitely doing more analysis on that, not for this particular paper, but trying to understand essentially traders, what they're doing on this market, why there's this demand. Also in issues that Gabriel mentioned that are quite important as anti-money laundering. There's a lot of money laundering going on in these crypto markets that we're aware of, and try to pinpoint that and then create tools that would prevent or curb this proliferation of this type of activity, or illicit activities, for instance, is quite relevant as well. So this is also an opportunity, because I know most of you do research. So if you're interested in any of these topics and you want to collaborate in the future with me, with my co-authors, you're open to it. Is indeed excellent ideas are popping up, and fortunately I'm not there in person, but I'm sure that I would get more ideas in the break. But if you feel like following up with an email or something like that, let's chat. And I appreciate the opportunity to have these high level talks and hear these good comments. Thank you.
Excellent. Daniel, Gabriel, thank you very much for your participation here.